Sanjay Mookim joins us now. Let's take our conversation forward. Let's understand what he makes of this crazy volatility in the global market. Sanjay, good morning. Thank you for joining us. If I say the word crazy, I think it's an understatement because with each passing day, I'm getting a sense that either central bankers are confused or they are worried about how to strike a balance between growth and inflation. 2 weeks ago, BOE wanted to increase rates. Now they're intervening, trying to bring the yields down. What is going on?
Well, as you just said, there is a whole lot of volatility in the world, and these have been created, you would argue, to some degree by extraordinary circumstances, right? The whole lockdowns in China, for example, the conflict in Eastern Europe, and these are not part of your standard operating procedure. You don't know how to normally react to some of these, and these are causing challenges, extended challenges for policymakers across the world. I mean, on the one hand, you have to counter the rise in inflation, the rise in commodity prices, and in many parts, the inflation is now no longer linked to commodity prices. It's become a little bit more core. And while most developed economies are sitting on these mountains of debt, and you cannot allow for that debt price to erode as well. So there are these challenges, compromises, and it will be a very difficult task for many policymakers to navigate through these issues. And the only hope that all asset classes and all investors have is that somehow we are able to engineer a bit of a soft landing and manage to see our way through these processes without causing something to break somewhere.
Indian markets have been decoupled when global markets were going down. Will it remain like this, that we will chart our own course even if global markets come back, we are not going to get recoupled, we will remain decoupled?
There are two layers of answers to that, I would think. One is, forget what the market is coupled or not. Is the economy coupled or decoupled? Now, the assumption from a lot of investors we have is that the Indian economy is a little bit more insulated from all this volatility, economic volatility everywhere in the world, and that is partly correct. But the risks that you run is that this tightness and this increase in rates and increase in inflation you see everywhere in the world will also translate to some sort of similar concern in India. And that Indian monetary authorities will also be forced, their hands will be forced to continue to tighten domestic liquidity, continue to raise domestic rates in response to what is happening in the world. So you're never fully 100% decoupled anyway. And the question to debate is how much further will the RBI's hands be forced in keeping liquidity tighter, in raising rates in India first, and that will then transmit into local equity markets, local bond markets as well. And I would argue a little bit that we are not fully decoupled, that there will be transmission risks to the Indian economy also.
Sanjay, so what's the expectation? What would the markets like to hear from the RBI governor tomorrow, while it's a given that it is going to be a rate hike?
Well, look, I think a 50 basis point rate hike is consensus. What is more important to my mind is the tone of the conversation. Will the RBI become a little bit more hawkish given what's happening everywhere in the world? Credit spreads in India are fairly tight still, arguably. Do they start to move post the RBI action? And I think the debate, as is true everywhere in the world, is what is the peak rate? Where does the rate cycle peak out even in India? How much does the liquidity tighten? We're already seeing credit growth in banks outpacing deposit growth. What are the dynamics of that? If the RBI continues to keep liquidity tight, how does credit start to flow in the economy, which was the big hope of a revival in activity? So these are the questions that the market would like some cues for, and we'll see how the governor responds to these.
So, since you do believe that we're not quite decoupled from the rest of the world, and that, volatility in currency and capital markets is going to be a challenge for the economy at large, I wanted to understand, how can investors then best cope with this kind of volatility in capital markets? What's a good hedge, and what is it that you need to completely exit?
Right. So there are these interchangeable words. Volatility is equal to risk, right? In mathematical models, in standard college textbooks, that is what risk means, volatility, heightened volatility. And if you do not see this volatility going down, for example, you do not see clarity on Chinese economic outlook or the war in Ukraine, for example, then the argument by association is that as long as this volatility remains high, you should not be adding risk in asset allocation, whether it is in India, whether it is overseas. Now, what do you mean by risk? Is that you stay within the equity portfolio, we stay with the large cap, the quality companies, risk equals mid cap, lower liquidity stuff. And that is what we've been arguing in our research as well, is that until you get clarity on where this world is going, you need to stay away or reduce the allocation to risk in your equity portfolio. So stay large cap, stay defensive, stay with the quality companies. And our preferred sectors, therefore, by association, are the banks, staples, which are quality and defensive in this environment.
You have spoken about defenses, large caps, banks, etc. I'll come to that later, but believe it or not, we're already at the cusp of the next earnings season. So I wanted to get in your thoughts then in terms of what the expectation is. Do you believe that there are going to be certain pockets where we will continue to see pain or any surprises on the upside?
Right. So let me track back to what we heard at the JP Morgan conference that we hosted in Delhi last week. We had over 500 participants, 70 companies talking about some of these sort of questions. And what we hear in general is that the mass market consumer basket, the low end of households, is still struggling to some degree. And yes, there is hope that with the reopening and the sustained activity improvement, consumption levels will start to continue to track up. But we're not hearing too many green shoots there. The higher end consumer baskets and the more discretionary companies continue to talk of robust demand for now. Plus, of course, there is this belief that the festive season, Diwali at the end of October, will prove a catalyst for further cyclical upside to many of the consumer sectors as well. My only submission is that look, the September quarter results, there is some seasonal weakness expected due to the monsoon, which happens every year. But what you will likely see is that getting into the December quarter, that's when the challenges will mount a bit further, because the base effects from last year are very stiff. So the June quarter was very good because the denominator was very nice and companies reported high double-digit growth. But as you get into the December and March quarters, base effects from last year will be very high, and naturally you will see a lot of these expensive, consumerish sort of companies report very modest growth numbers, and that to my mind can become a little bit of a challenge to markets as well.
Sanjay, the consensus view is that India is trading at a huge premium to emerging markets. Is this a right comparison? Because A, these are historical benchmarks. B, the growth dynamics are very, very different. So, it's like saying that the property price at Pedder Road will always be higher than property price in Andheri. Because there is a reason. That's a geographical advantage. That's a location. There is a sea view. Can I say the same for India, that we deserve to be expensive?
Well, let me not make a qualitative comment here, but you are right that at least since COVID, India has stopped behaving like an emerging market. And for, let's say, the 18 months from Jan 20 to now, the Indian index was actually more comparable to the S&P 500. Now, there could be reasons for this, as you alluded, that's because there was more issues with the North Asian countries in particular, and India is exposed to that kind of uncertainty to a much smaller degree. And, many other countries in EM have their specific challenges. But what is happening now, and which is what is making me a little bit more nervous, is that we've outperformed the S&P 500 significantly in the last few weeks as well. Our PE premium to the S&P is at a 10-year high, whereas our growth premium to the S&P is actually at a 10-year low. And this is a little bit more difficult to explain because, the S&P is a hard currency asset. It's got better one-year growth and it is cheaper. So to argue that India will continue to re-rate relative to developed country equities also, that argument becomes a little bit more difficult to push.
I'm going to specifically focus on if one has to choose between being overweight on banks or IT. They both have different growth dynamics. One sector which is contracting but has fallen. One sector which is expanding but is outperforming, that's banks for you. Purely looking at the price and what markets currently are factoring in, for next 1 year, should one be overweight on banks or be a contra overweight on IT?
Well, banks for sure. And the way we filter stock selection or sector selection, especially if you have, let's say, a 12-month investment horizon, is to look for earnings momentum and, more importantly, the second derivative of earnings. Are earnings going to disappoint or earnings going to beat expectations? And the expectations are defined as the median of all the sell-side consensus analysts available on many data feeds, right? And what I would argue that despite whatever underperformance you've seen in IT in the last several months, you have not yet seen a full completion of the downgrade momentum in earnings. Yes, we've understood the pressure on margins that IT companies are going through, but there is still the risk that top-line momentum will slow given what is happening to many of the Western economies, which are the big drivers of demand for these IT companies still. We've not seen that leg of downgrade happen for IT, so it may be a bit too early to go bottom fishing and becoming contrarian in IT just yet. Banks, there is very little risk of earnings cuts or earnings misses in the near term. Loan growth is actually improving, and margins will all improve in the next 2 quarters for sure, and then we'll see how the liquidity plays out. But it's purely from a relative earnings momentum point of view, banks still look much better than the IT companies do.
Sanjay, just a couple of days ago, we were talking about, very optimistic comments coming in from the Nestle global CFO saying that they're very, bullish on the overall commentary in India as well as how the Indian markets have been doing. I wanted to just get in your take on the entire consumption basket and, what the outlook would be on the FMCG space and how you'd really look to play that basket.
Well, I think the answer to that question is necessarily a much longer time frame answer. And if you think of the structural advantages of India, this is enough to be positive about, right? The demographics is very advantageous. Productivity growth is very strong in India, and that's actually a very rare thing in many countries globally. You are seeing the manufacturing endeavor of the government yielding some results for now. And India has all this digitization, the infrastructure spending. So we've done our pieces of research as well, talking about the big structural advantages of India. And the net result of all of this is that India's consumption pie will continue to expand and upgrade. So when you hear from these corporate leaders and the macro analysts talking about India's advantages, that is right. And if you are looking for steady, continuous growth pockets in the world, India will probably rank as the top 4-5 destinations where you can achieve that. Now, the trouble is, however, that when you justify near-term 1 quarter, 2 quarter stock moves by continuously pointing to that structural advantage, that becomes a little bit tricky because, stock markets don't necessarily always discount 5-year views or 10-year views. And you can see disappointment and earnings cycles in some of these stocks and matter to stock prices in the short term, even though the structural advantage will sustain.
Sanjay, how to your mind you think the move of floors is going to pan out? Because we have seen an excruciating FI pull off from our markets as well so far this month. Having said that, we're a lot better positioned than other emerging markets and surely much better positioned than our US or UK counterparts. Just wanted to understand whether you think that we will continue to see outflows from India if global markets continue to remain under pressure.
Yes. So if you look at the data, the flows or the direction of flows into India is determined, a lot by global allocations. It's not necessarily India-specific inflow or India-specific outflow. For example, in the last month when we saw the inflows from foreigners, it was coincident with inflows into many other countries in Asia. It was not just an India-specific inflow. And when it is turning out in line with what is happening in other parts of the world as well. So it is generally a broader tone on EM assets or Asian assets which is driving the direction of foreign flow into India. The good news, of course, is that Indian domestic flow remains very robust. And I don't think that is going to go away quickly unless there's a very big price shock. So people need to lose money before they stop investing in Indian equities. And hopefully that doesn't happen.
So Sanjay, a year from now, in hindsight, when we will look back all this global volatility, do you think bulls will have a last laugh or the bears would have a last laugh?
Well, the path matters a lot. The end state, I hope it is always bullish for us and that you don't end up in a permanent state of despair as far as asset prices are concerned. But the worry, of course, is that you might have to go through a period where this volatility remains elevated and that asset prices have a significant drawdown in response to what is happening to monetary policy, right? So we are always optimistic in the long term, but how you get back to a normal state and what happens in between, that's the concern that most investors have for now.
Great to have you in the show as always. Glad that you could take time out.